Hey, good morning YouTube. Today I want to go through the changes in my portfolio in the last 6 months or 5 months. I think the last update I did on what I've been doing was 5 months ago, and so I'm going to go through that same sheet with you real quick and just show you what I've been doing, what I expect to be coming, and maybe the difference between that and what the market is happening. So let's get going here. So here's kind of the sheet. Last time I had bought one rental in Arkansas at a 6% return, negative cash flow 292. I just bought a new rental in Missouri. The last video that you look up on my channel goes through the exact numbers on that rental house. Before some of the expenses, we'll just say it has an 8% capital return. And then I also have, putting this down so I remember what I told you last time, a contract for the end of July on a new rental in Missouri. Also, that return is, I think the rent estimate is at least $1,800 per month. The price is $240,000. Right now, there's nothing in the market at these numbers, so it was a good deal, and the markets are going crazy. They might adjust, but I have quite a bit of a buffer in this price, and so I'll just figure a straight rate is 9%. Now that's before expenses, but expenses in the Kansas City area, I just adjust the expenses to what they'd be in Arkansas, and so that's 9% before expenses, which is pretty good. Cost of capital last time increased to 7.25, and now it's about 7.5. So that to 9% makes it about even. I bought it probably below market by about $30,000-$40,000 based on the rent, and in addition to that, with the inflation at 5%, if you take the first year, I will make, let's say, $30,000 on the discount in the house. Then I will make, we'll say, the value of the house, which is, let's say, $280, and take that times 0.05 for inflation. The first year I'll make $14,000 on inflation, and then with the cost of capital being 7.5, there will be a negative cash flow, but I will also make probably profit of, let's say, mild, maybe $2,000 in the first year. And so in the first year, I would expect on that property to make a net of about $46,000. A lot of that being in the monthly, in the actual purchase of it below market value. Part of it being in inflation. Now next year, I expect this inflation number to be lower. This purchase number will not be here, and so we're probably going to increase the profit on the operating side of the rental. But these are all real numbers that affect you over time. From an investment standpoint, as the market has gone up, I've sold my Walmart. I still do DCA from an automatic payment I have, but I sold this. I sold my Home Depot, sold my VIG. Now this is in the two accounts that I do more trading in. An HSA account and my brokerage account. And so I have a lot of cash. The Solana, as far as crypto, is still staking on my Ledger Nano. I'm getting a small return on that. Not worried about that at this point. I'm just trying to stay there and aware of what's going on in that market. These are the experiments, and I will tell you, I sold this. I sold the Paramount. I sold the HP. I sold the City, and in Ally, I am just holding. I think it's making about we'll say a 4% dividend right now, and so I'm holding this amount. I might sell that at some point, but I have not sold it yet. I think I have about 18,000 in here. So treasuries, I did add 3 more. So I have in my brokerage, I have a total of 6 treasuries. And I'm also buying on the secondary market some CDs, and the prevailing rate on these is 5.3%. In general, they are between some come due next month, some come due about 3 months, maybe 1 to 4 months in length of time till they come mature. In my HSA, I have about the same. I'm just going to say same here. Same in HSA. The amount is probably about the same right now, total. Although I do buy larger denominations in my HSA, and the new ones are about 5.3%. I think my last one was a CD at 5.3. Paid off the line of credit that I had before, so I'm going to get rid of this. I have a loan that resets in March. It's currently at 3.85%, and I'm estimating it will reset at 8 to 10%. And I will tell you about that. They said they were going to pause, stop increasing rates at 5.25. The market said that, and then they came back and said, nope, I guess we're not going to do that. And so right now, rates are at 7.5% for me, for commercial. And so this figures in another 0.5% that I know they're going to increase, and maybe 2% more. I think that the increase in rates that they've done have not had the effect that they want. They brought down inflation, but core inflation is still at above 5%. Core is above 5. And so I think that based on this being above 5, I think they're going to bump it maybe to 6 base. Okay? And they'll tell you right now they're going to do that, and I think they're going to keep it here for 1 to 2 years. Okay? So I think that's what's happening. Or the other thing is something may break. Now, I'm not sure what they consider to be break. If commercial companies, loan companies, commercial companies go under, that doesn't reflect on the Fed. The general American people don't know that that's caused by the government money policies. And so I don't think it's going to be that. I think it's going to be a major bank failure. So if a major bank failure happens before they get to whatever they think their actual target rate is, then they may adjust their target and not go higher. Just make it out for longer. Or they may talk to the banks and say, hey, do you want higher or do you want longer? Like which ones? Because if they go and they just stabilize at, let's say, 5.25%, that may be good enough if they keep it there a year or two to keep big inflation down. But if they go higher, something else is going to break, and that may bring it down. And what that breakage will be is most likely it will be this, or it will be commercial properties. And so basically, through commercial properties, they will be destroying money. So if you have a bankruptcy of let's say a $1 trillion company, that essentially destroys a large amount of money. And so if the total money on the books right now in the US is $20 trillion, let's say, and you have a $500 billion loss like that, that may decrease the total money supply by that loss. The same as it goes up, it increases the money supply. Lastly, my sales companies, I just did one closeout of basketball shoes. And And we're selling, I would say, pretty much a normal amount. I don't see much change here. But you know, these sales companies kind of provide just a lift to the overall portfolio, because these pretty much don't bring in a large portion of profit per se. We have the increase in value of assets, you know, the purchase when we increase, you know, the net worth, and then we have some cash flow and cash flow in the older properties. But I just wanted to take time to kind of show you what the changes I made were recently. So overall, just to cover, number one, having sold a large portion of stocks to be in a lot of cash. Here's the way I see that decision. Put it this way: if this interest rate continues to go up, these securities will be hit. People do not have priced in a 8 to 10% base commercial rate into these stocks. And so this will continue to be a drain on these companies as this rate continues to increase and hurts them over long term. Number two, if the interest rates go down, that is such a boon for my real estate business that not having these stocks that they go crazy doesn't do anything for me. And so I'm kind of hedging my bet there. If interest rates go down, my real estate is going to gain and be fantastic. And if they don't, then this will drop, and I'll buy back into some of these stocks at that point after they get pushed down some. Now, I don't think they're going to crash, but we'll say maybe a 10% adjustment down to where they were earlier, when the expectation was interest rates were going to continue to rise, and we don't know how far. See, the Fed has kind of given a pause for a month, and then they say, hey, maybe 0.5% more, so the market's like, okay, cool, you know, 0.5% more. But I don't think they're telling the truth. I think they have no idea how high they're going to have to raise it, and they're just trying to tell the market what will make the market not freak out. But in actuality, if they told the market the truth in the first rent, the market would have crashed, would have taken a huge dive, and that really would have reset a lot of inflation a lot faster. But they're trying to do what they call a soft landing by basically lying about the destination of the interest rate and how long it's going to have to be there. And then, you know, the market's still expecting adjustments or decreases to come within the next 9 months. And I'm about 90% sure that they will not, unless we have catastrophic failures. You as a person, those catastrophic failures might make your 401k go down some. Just hold on to it. You shouldn't be making any moves based on what's happening in the economy if you're, you know, pretty normal. And just understand what's going on, and don't be afraid. Maybe when you see a dip, you know, buy a little bit, but be prepared to not sell when the market goes down, because the market going down is an indication that people are selling. The people that are selling when the market goes down are the people that do not understand what's going on. So that's all I got for you today. Hope you guys have a great day. Like and subscribe. Maybe hit me a comment, ask a question. I'll talk to you guys later. Bye.